Hi, I'm Andrew Clayton, President of ParetoHealth, and today I'm going to talk about the captive terms as compared to a fully insured renewal. And really I'm going to talk about the mistakes that most people make when they're reviewing both. When people think about fully insured and they compare it to the captive, oftentimes they compare the fully insured premium to the captive's worst case scenario. So they look at the captive, add up the administrative cost, add up the stop loss cost, and also add up the self-insured layer maximum, so the aggregate attachment. They combine all those and say, this is our maximum, and we need to compare risk, and so we're going to compare the maximum versus the fully insured renewal. And by doing so, they're comparing a false positive. They're actually comparing the fully insured renewal's best case scenario, because regardless of how well you run, your premium is never going to be lower than your annualized premium. If you generate a 25% savings for the insurance company, they're keeping all of that, and you've now paid your best case scenario in terms of the premium. So if you're going to compare best case scenario in the captive, you have to look at what the savings can be relative to being self-insured. And so our members average a 7.5% savings year one, and over 80% of our members average over a 10% savings year one. And so if you want to think about best case scenario, that's the number you should be comparing against the fully insured renewal premium. Conversely, if you want to compare our worst case scenario, meaning the captive's worst case maximum, to a fully insured premium, you're only going to pay the maximum if you have a horrific claims year. And if that happens, you need to think about what the fully insured renewal is. This is the most important part, because that's the worst case maximum in fully insured. It's not what you're paying this year, it's what you pay next year that is in response to what your high claims were this year. And so we all know that renewal in a bad year can be 30, 35, 45, 55. We see 75 and 100% renewals. So if you want to compare worst case to worst case, compare our year one maximum to your second year renewal when the train runs off the tracks.